Hello and welcome to Sectors Up Close. I'm Angeline Ong. Our focus today is real estate and our guest is Chris Beauchamp, the Chief Market Strategist at IG. Now, the real estate sector has been seriously upended by the pandemic, with offices in many city centres devoid of people. This index, the FTSE 350 Real Estate Index, is still down around 7% over last year, but the sector is broad, encompassing builders, developers, as well as dividend-paying real estate investment trusts that focus on everything from shopping centres to healthcare. So what is the outlook for this sector this year? Let's ask IG's Chris Beauchamp. Chris, thank you so much for joining us. It's such an interesting space. I know you said that for the longer term, the outlook for this sector amid the pandemic is harder to pinpoint. Why is this? Is this because there is this uncertainty whether people will go back to offices?
Yes, I think there is. We're very much in a unknown at this point in time, really, when it comes to the scale of the return to offices. We've had pronouncements that the office itself is dead and gone. We've had the opposite end of the spectrum, notably from the head of Goldman Sachs last week, saying that it just doesn't work to have people working from home. I suspect the truth lies somewhere in the middle. I would say people going to the office maybe 2 to 3 days a week, say 2/5 of the time, compared to where they were just over a year ago. And I think that's the question over how much demand you'll need for offices particularly, and then where that space goes or what becomes of it in the wake of this. If you turn them into apartments, that's fine, but the rationale for that is somewhat odd. And of course, all that retail space that's been hit, of course, with the absence of workers in the city and the huge shift to online shopping means that there is fundamentally much less demand for the kind of retail space and much less footfall to support the retail space as we head into the second half of 2021 and beyond.
How about dividends, Chris? We still have quite a few good-paying companies in terms of dividends. Are they attractive given what's going on and how this pandemic might affect future returns?
I think they are. I think certainly it is perhaps, even with the previous question, they are a lot more certain in terms of their outlook than they were a year ago. We know, for example, of course, that people will go back to the office. And as a result, some of those dividend yields, which hover for some of those companies in the sector around 4.5 to 5%, do still look quite sustainable, I think. And that's a good thing for investors. I don't expect to think they'll increase dividends, particularly for the time being. They're just going to leave them where they are. You have seen, of course, a big drop off in the amount of rents being paid, but it looks like investors are prepared to look through this in the hope that things will return to something more like normal as we go through the rest of this year.
How would you advise investors who still want exposure to this space? Should there be subsectors they should be looking at?
Well, I think we want the ones where there's likely to be increased residential demand more than anything else. I think that's the area where there is likely to be perhaps an improvement as economies return to normal. People will be looking back to move around more rather than obviously being in lockdown. The areas you want to be cautious about remain, of course, I think most importantly, retail, particularly, of course, in the UK. You've seen this divergence in a number of the REITs. The ones focused more heavily on retail have suffered more than those with the more diversified portfolio. I think that's something that's being reflected in their relative performance. So you see those dividend yields begin to creep back again. And the valuations, of course, have improved markedly from where they were a year ago. I think those are the things to bear in mind, that rights shouldn't be treated as one single group. You have to look past that and make a case for saying, actually, there are pockets of strength and there are some cities that will do better than others. And maybe even if you're looking further out from the big cities, from New York and London, for example, to regional cities, that will see a bit of a growth as people eschew commuting to those big names and look to work more regionally in the future.
Right, thank you very much. We have to leave it there. That's Chris Beauchamp, Chief Market Strategist at IG. And before I go, here are some of the top stories in this sector. Britain's third largest home builder, Taylor Wimpey, reported a strong start to the year and forecasts a recovery in sales and margins in 2021. The FTSE 100 company said it expected to build fewer affordable homes this year, boosting profit margins back to around 19% after falling to 10.8% last year. It's been reported in the media that Britain will extend by 3 months a tax break on home purchases and unveil a mortgage guarantee scheme in Wednesday's budget, moves that could further bolster the sector. British house price growth unexpectedly accelerated last month, according to mortgage lender Nationwide. House prices rose 6.9% in annual terms in February, above all forecasts in a Reuters poll. Nationwide said the outlook for the housing market was uncertain given Wednesday's budget and the likely weakening of the labour market as government wage support is withdrawn. And finally, a real estate brokerage backed by Japan's SoftBank has filed for an IPO. In its filing, Compass revealed a 56% surge in revenue to $3.7 billion for the year ending in December. And that's your roundup of the real estate sector. I'm Angeline Ong, and this is Reuters.